Well, welcome everyone to Steve Savant's Money, the Name of the Game. I'm your host, Steve Savant, syndicated financial columnist and money color commentator. On today's show, I'll look back at the S&P 500 index, part one in our series on Index Universal Life, an emerging asset class, with nationally recognized retirement expert and certified financial planner, Chris Jacob. Welcome to the show, Chris.
Thanks, Dave.
Chris, why did you frame this whole idea of Index Universal Life as a new emerging asset class? I'd never heard anybody talk like that.
Because it's an asset class that most people don't recognize as even being an asset class, but as you're going to see, it can play a very important part in overall retirement planning insofar as tax strategies and unwinding some tax traps, if you will.
Now, a lot of people buy the S&P 500. I mean, they see the VIX report every day on television. They buy the S&P maybe through a mutual fund, maybe through an ETF, maybe through an annuity. We're talking about a whole new asset class using life insurance as the chassis. So why don't you walk us through some of the basic history, because according to your model, there's some pretty good history to be had here.
And what you're seeing here is this is simple math. If I've got $1 million and it's getting 6% and I've got 60,000 credit, my year-over-year credit the next year is 63,600. And if we go out, though, a little further, and let's go out to year 10 here, where even though my nominal yield was 6%, my effective yield was 10.13%. How do I get effective yield? I take that interest credit divided by my original $1 million of investment, and that gives me an effective yield of 10.13%. And assuming no taxes, no cost to manage, you know, Einstein said the eighth wonder of the world is the miracle of compound interest in a tax-free environment, however. We get out here to year 20, and we got an effective yield of 18.15%.
Now, why is this different than when you see a normal Ibbotson chart of the S&P 500 and it says, hey, we did 12?
Because actual return versus average return is two different things, okay? And we can show the math on that, but actually you could have an average return on an investment over a 10-year period where the investment made 12%, but the investor lost money. Because the only way the average and actual are going to be the same if there was no down years. That rarely happens, okay? So if we have a down year, actual and average won't be the same. So here's a question of how can we get an average rate of return of 6% and, more importantly, get it to grow tax-free and protect all principal and gains from any down markets? That'd be good, wouldn't it?
Yes, and before we got into indexing, when they first told me, when I first heard this, what you just said, I thought, impossible.
It is possible. Anything's possible in the realm of planning. It just depends upon your complexity threshold. So here's a question. Does anybody know which way the markets are going? Right now they're roaring, right? It's a bear. I mean, it's a bull. But are they going to be a bear? Are they going to fight each other and go sideways? Who knows? And if they tell you, they're lying. So question, Steve, how many years in the most recent 10-year calendar period do you think the market's finished calendar year negative returns?
The last 10.
The most recent 10.
10.
As we sit in 2016 today. At the end of
I only can think of, if you're counting the 2008, that was it. And we had a bad little boy at 215 at the end.
That's true. I'll get people in the financial services industry telling me 3 and 4 times, when in fact, it's only been down once in the last 10 years. Prior to that, it was down 3 times, and prior to that, it was down 1. So in the last 30, it's finished negative 5 times. Does that surprise you?
It surprises me because I've been around for 30 years. I've had my 401k online for this period in time that you're talking about. Yeah. So, yeah, this surprises me.
Well, if you turn it on CNBC, they tell you it's happening all the time. So here are those decades, or those 10-year periods. We had the Great Recession in 2008. We had the terrorist attack, the dot bomb, the aftermath of over that previous 10-year period. And then we had Iraq invades Kuwait. So out of 30 years, the market's been down 5 times. It's averaged 11.6%. So we say, what if we could employ a strategy where 0 is the worst you can do in a down year, but you were capped at 11? What would that do? Well,
let me just stop you, just make sure we all understand. That last slide included dividends. Isn't that correct?
That's correct.
That included dividends. Okay, now, you just said, what if we could protect the downside? I got that, 0%. But you said cap. So that means our performance, to make sure we don't have a bad boy year, we're going to give up a little on the top end.
Correct.
All right. Okay.
And we're going to get the S&P 500 without dividends.
Without dividends.
Okay. So
there's a trade-off. There's a trade-off.
Yeah, so 10.88 with dividends, 8.99 without dividends.
That's still pretty good.
Yeah.
Yeah.
So not 2% differential typically. So what we're saying is if you could do that, you wouldn't have to ride those down years. You know, losing money feels twice as bad as making money feels good. But what did you give up? Well, you give up some growth because rather than 11.6, you averaged 6.79, but you didn't have to endure those sleepless nights.
Mm-hmm.
So let's go back in time and look at the various decades. What percent of the time was the market up versus down in those decades? Well, obviously in the Great Depression decade, down more than up, but up 70% of the time in the 40s, 80% of the time in the 50s, up 70% of the time in the 60s and 70s, up 90% of the time in the 80s and 90s. And then, yes, our lost decade, where if you'd have been a buy and hold investor, you'd have lost money. One of the rare 10-year times that would have happened. The market was still up 6 out of 10 years. So the only decade we had where there was more losing years than winning years was that decade of the Great Depression. And we've had some challenges in those other decades and still more winners than losers. I'm an economics major. I love the classic bell curve because so many things seem to fall in line with that classic bell curve. And what you're seeing here, blues are years in which the market was positive, 0 to 10, 10 to 20. Some outliers here, 40 to 50, 50 to 60. Conversely, red, years in which the market was down. And it's been up more than down 73.6% of the time. As a matter of fact, if it finishes up this year, which in all likelihood it will, we're going to be at 75%. But if you look at since 1930, we've had some down years, but we just asked people, how much better would you sleep at night if those down years didn't have any effect on your principal or your gains? I had one client said, you gave me the Swan portfolio. I said, what's a Swan portfolio? He said, sleep well at night. So we just went through these facts. Since 1930, the S&P's been up 73% of the time. In the last 30 years, it's been up 83%. Last 20, 80, last 10, 90% of the time. But based upon what we're going to talk about with the strategy, what's critical is this. When it's up, what percent of the time is it up by double digits or more? As you'll see, Steve, and probably know, when the market's up, it isn't up usually 3 or 4 or 5 points. It's up 10% or more, roughly 75% of the time. When it's up 10% or more. And that's critical for the strategy that we're going to talk about employing here. So what if we could put a constrained strategy in where 0 was the worst you can do, but 11 was the best you could do? You got credited anything in between, S&P without dividends. And if we take a look at that worst decade, the worst investing decade this country's ever seen, out of the chute on $1 million starting in 1930, you were down 25%, and then 3 back-to-back losing years in the market, which until 2000, 2001, 2002, that's the last time we had 3 consecutive losing years in the market. Most people bailed then. Your million was worth $390. Interesting. If they had held on for the 10 years, they'd have been about back to even. Nobody could do that. As opposed to if we got a 0 floor, 11 cap in the worst investing decade this country's ever seen, you would have actually made money. All right? So why? Yeah, 54% on a good bounce back year, but 54 coming off at 390. Limited to 11 on this side of the ledger, but 11 coming off $1 million because you didn't lose anything in the down years. Now, if we put that to music during our lost decade, what happens? Well, we got $1 million to start with. We get the S&P with dividends, buy and hold investor. There's the rare instance where they lost money. On the other hand, 0 floor, 11 cap, without dividends. Same period of time, I wind up with almost $1.6 million, a $680,000 differential.
Which to me is a big play here to make sure all our consumers see this, because that spread difference between what the total yield was without dividends, and the actual loss in the market, that spread difference is the hedge position. That's what's protecting us. To me, that's a huge issue to see 0, 0, 0 against my ledger.
We call it 0 is your hero. Okay?
Yeah.
So let's take a look at this most recent 10-year period, which I think most of us would agree is a pretty good one, given the fact the market's only been down 1 out of those 10 years. All right, $1 million, I would have wound up with $1,955,000 S&P with dividends. 0 floor, 11 cap, no dividends, S&P. Okay, I finished $44,000 less. But again, no sleepless nights. All right, what's that worth? So that's if you're in a buy and hold situation. What happens for those of you out there, and ultimately all of us get into that distribution phase of if we've got a $50,000 withdrawal. So at the top, you'll see we got 2001 starting with $1 million, pulling 50 grand at the beginning of the year. S&P with dividends, no cost to manage, no taxes. You wind up with $628,000. On the bottom part of the slide, we got that same time period, same initial million, same 50 coming out, 0 floor, 11 cap, S&P no dividends. I got about, what, $500,000 more, because the effects of the negatives are exacerbated even greater when you see what happens to the impact of withdrawals, okay? So that's during, there was 3 down years there. What happens if we look at our relatively good 10-year run that we've had here recently with $1 million going in, the S&P with dividends only being down 1 year of $1,038,000. But think of this, even in a 10-year run in which the market was up, 9 out of those 10 years, $1 million going in, 50 coming out, S&P without dividends, 0 floor, 11 and cap, still beat riding the market.
Well, to me, this is a huge thing for us to think about, the history of the S&P and how to employ it in this new emerging asset class. To me, that's where we've got to go. Listen, don't forget to watch our next segment on the tax advantages of cash value life insurance, part 2 in our series on Index Universal Life, an emerging asset class. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, financial advisor. You've been watching Steve Savant's Money, the name of the game.